Hello everyone and welcome to Financial Accounting. Today we continue going over liabilities and we'll look into long-term or non-current liabilities. If you haven't had a chance to watch the video about current liabilities, I'm posting the link here and in the description box. Liabilities may be defined as debts or obligations arising from past transactions or events that require settlement at a future date. Liabilities can be separated into two categories: current and non-current. Unlike current liabilities, long-term liabilities are not expected to be paid within 1 year or within the operating cycle, whichever is longer. Also, long-term liabilities are usually not paid from current assets or through the rendering of services. Some long-term debts, such as mortgage loans, are payable in series of monthly or quarterly installments. Principal amount due within 1 year or the operating cycle is regarded as a current liability. Remainder of the obligation is classified as a long-term liability. What else do we need to know about long-term liabilities? Transactions involving long-term liabilities are relatively few in number, but usually involve large dollar amounts. Long-term debt financing may become a permanent part of the business's financial structure. Many long-term liabilities and some short-term ones require the borrower to pay interest. Only interest accrued as of the balance sheet date appears as a liability in the borrower's balance sheet. The borrower's obligation to pay interest in future periods may be disclosed in the notes to the financial statements, but it is not an existing liability. One special type of long-term liability is an obligation that will mature in the current period, but is expected to be refinanced on a long-term basis. If management has both the interest and the ability to refinance soon-to-mature obligations on a long-term basis, these obligations are classified as long-term liabilities. Examples of long-term liabilities are installment notes payable, usually used to purchase real estate, certain equipment, and other planned assets, and bonds payable, which are very long-term notes maturing in as many as 15 to 30 years. Installment notes call for a series of payments. Each payment includes some payment on the principal and some payment for interest. Most car loans and home loans are set up on installment payments. Often, the required payments are the same each month. For each payment made, the amount of the principal payment increases and the amount of the interest payment decreases. When companies need large amounts of cash, they often use bonds. The bond principal is typically paid at the end of the bond period. Bonds are usually denominated with a face value or par value of $1,000. Bonds usually have an interest rate called as stated or contract rate. Interest is usually paid semi-annually and is computed as principal times rate times time. I'm sure you know this already if you watched the video Accounting for Notes Receivable. Bonds are issued through an underwriter. Many bonds are traded on organized securities exchange, such as the New York Stock Exchange. Since bonds are bought and sold in the market, they have a market value or price. For convenience, bond market values are expressed as a percent of their face or par value. For example, a $1,000 bond priced at $102 would sell for $1,020. There are several types of bonds. For mortgage bonds, the issuer pledges specific assets as collateral. Debenture bonds are backed by the issuer's general credit standing. Convertible bonds can be exchanged for a fixed number of common shares of the issuing corporation. Junk bonds have a very high risk associated with them. We will discuss accounting for installment notes and bonds payable in separate videos. Loss contingencies result from an existing situation that involves a potential loss, depending on whether a future event occurs. An example of a loss contingency is a lawsuit. In this example, the potential loss depends on whether the lawsuit is successful or not. Two factors affect whether a loss contingency must be accrued and reported as a liability. One is the likelihood that the confirming event will occur, and the other is whether the loss amount can be reasonably estimated. If it is probable that a loss contingency will occur, and if the loss amount can be reasonably estimated, then a loss is accrued and reported as a liability. Now, let's look at an example. The following are selected items from the accounting records of Green Mountain Corporation for the year ended December 31st, 2021. Note payable to Northwest Bank is $500,000. Income taxes payable, $40,000. Accrued expenses and payroll taxes, $60,000. Mortgage note payable, $750,000. Accrued interest on mortgage note payable, $5,000. Trade accounts payable, $250,000. Unearned revenue, $15,000. Potential liability in pending lawsuit, $100,000. We also know the following. The note payable to Northwest Bank is due in 60 days. Arrangements have been made to renew the note for additional 12 months. The mortgage requires monthly payments. An amortization table shows that its balance will be paid down to $739,000 by December 31st, 2022. Accrued interest on the mortgage note payable is paid monthly. The next payment is due near the end of the first week in January 2022. Using the information provided, prepare the long-term liability section of the balance sheet dated December 31st, 2021. First, we need to go over each item and decide whether it is a current or long-term liability. The first item is the note payable to Northwest Bank, which is due in 60 days. We know that arrangements have been made to renew the note for additional 12 months. The key here is that the note will be refinanced for additional 12 months. Although the note payable to Northwest Bank is due in 60 days, it is classified as a long-term liability because it is to be refinanced on a long-term basis. Now, let's look at the mortgage note payable, $750,000. We know that an amortization table shows that its balance will be paid down to $739,000 by December 31st, 2022. The $11,000 principal amount of the mortgage note payable scheduled for repayment in 2022, which is calculated as $750,000 less $739,000, is classified as a current liability. The principal to be repaid after December 31st, 2022 is classified as a long-term liability. Income taxes payable, accrued expenses and payroll taxes, and accounts payable are usually paid within a year, most likely in 30 to 60 days, and therefore they are reported in the current liabilities section of the balance sheet. The accrued interest is payable within 1 month. Therefore, it is a current liability. Unearned revenue is also a current liability. When services are prepaid, they are usually provided within a year unless agreed otherwise. Don't forget to watch the video Current Liabilities to learn more about it. The pending lawsuit is a loss contingency, as no reasonable estimate can be made of the loss incurred, if any. This loss contingency doesn't meet the criteria for accrual. It will be disclosed in the notes accompanying the financial statements, but it shouldn't be shown as a liability. Now, let's prepare the long-term liability section of the balance sheet dated December 31st, 2021. Only 2 items are reported in this section: the note payable to Northwest Bank and the mortgage note payable net of the current portion. Total long-term liabilities amount is $1,239,000. That's all for today. I hope you found this video helpful. And if you did, don't forget to click on the like button so I know what you think. Please also subscribe and click on the notification bell so you don't miss future videos. I will see you soon.